Welcome back to the deep dive. Today, well, we're not just crunching numbers, are we? We're diving into what feels like a high-stakes corporate drama.
Hmm.
Starbucks has been pouring billions into its Back to Starbucks strategy. It's this massive overhaul, really, aimed at reigniting growth, improving operations.
Big bet.
A huge bet. So the central question for us today is, are these latest financial results, specifically for their Q3 fiscal year 2025, which ended June 29th, are they proof that the coffee giant is finally turning the corner?
Right.
Or are they just experiencing, expensive growing pains on what could be a long, uncertain road? Okay, let's unpack this.
What's truly fascinating about these financial reports is they're never just about the raw numbers, are they?
No,
They
definitely.
tell a living story. It's about a company's big strategic moves, the market challenges they're wrestling with, and how their huge global presence plays into it all. This deep dive will absolutely reveal the tangible impacts of Starbucks' current turnaround effort. You see both the significant investments they've made and, well, the immediate financial outcomes.
Yeah.
It really speaks volumes about the evolving landscape for these major global brands.
And what's compelling about that, I think, is exactly that point. They're not just raw data. They tell a story about Starbucks' strategic gambles, their
Yeah.
fight against market challenges.
Exactly.
That's what we're here to unravel. So let's kick off with the headline figures, the consolidated performance.
Okay.
Starbucks reported consolidated net revenues increased 4% to $9.5 billion. Now, on a constant currency basis, that's still a respectable 3% increase.
No growth. Yeah.
Still growth.
Yeah.
But then profitability, how does that look this quarter?
Right. Well, Starbucks reported both GAAP earnings per share, that's their official accounting profit, at $0.49, and then non-GAAP EPS at $0.50.
Okay.
And the non-GAAP figure, it often gives us a clearer picture of the core business performance by adjusting for those one-time events.
Which is important here, it sounds.
Especially important here, yes. These earnings figures were notably impacted by a couple of significant one-time items, substantial investments in what Starbucks calls coffee house leaders,
Okay.
and a specific discrete tax item. Now, collectively, these had a negative impact of 11 cents on Q3 EPS.
11 cents just from those two things.
Exactly. And CFO Kathy Smith specifically referenced these as non-recurring investments in their Leadership Experience 2025 event, framing them as part of the tangible progress in their overall strategy.
So that $1.11 hit isn't just a cost.
No, it's a calculated strategic move.
Yeah.
Starbucks is basically signaling, look, we're willing to take a short-term profitability dip now
Right.
because we believe these investments in our frontline people are absolutely critical for building long-term customer loyalty and efficiency. It's a high-stakes bet on their workforce.
So it's a short-term hit to earnings then, essentially for a long-term strategic play. It sounds like a painful but maybe necessary step if they truly believe in getting customers back to Starbucks. But, how long can they afford that pressure? Speaking of getting customers back, what about comparable store sales? That's often such a key indicator of how engaged customers are.
Always a key metric.
Globally, comparable store sales actually declined 2%. This was driven by a 2% decline in comparable transactions, although there was a slight offset,
Okay.
a 1% increase in average ticket.
Yeah, that global comparable sales decline is certainly a top-line challenge, no doubt about it.
Right.
However, digging into the details a bit, the Back to Starbucks initiative is showing some encouraging signs beneath that overall figure.
Okay.
The company specifically noted that they are yielding 3 consecutive quarters of improving U.S. transaction comp,
Okay.
which suggests that domestically here in the U.S., they're starting to see a positive trend in getting customers back through the doors, even if the global number is still, in decline.
Right.
That's the glimmer of hope they're holding on to, I think.
That's a crucial distinction, isn't it? It's interesting how the U.S. transaction comps are improving, but globally they're still declining. Is that a signal that maybe the core strategy is primarily a domestic play right now?
Or just taking longer?
Or just taking longer to translate internationally?
Yeah.
Let's shift our focus and break down the performance by segment, starting with North America.
Okay.
Here, comparable store sales also declined 2%, with a 3% decline in transactions, partially offset, again, by a 1% increase in average ticket. So what was the overall financial impact for this segment, North America clearly seems to be bearing the brunt of these strategic investments and maybe some broader economic headwinds.
You're right, it is. For North America, net revenues edged up 2% to $6.9 billion. dollars.
Okay, so revenue up slightly.
Slightly. And this was mainly due to them opening 5% more company-operated stores over the last year.
Right, new stores helping.
Exactly. However, that gain was dampened by declining sales at existing stores and a drop in their licensed business. But here's the kicker. The operating income for North America saw a significant decrease,
How significant?
plunging 36% to $918.7 million. And the operating margin contracted sharply by 770 basis points year over year to 13.3%.
Wow, 770 basis points.
To put that into perspective for you, that's a 7.7 percentage point drop. It means Starbucks kept significantly less profit from every dollar of revenue this quarter in North America.
Ouch.
Yeah. This contraction was primarily due to deleverage, which means their fixed costs, like rent and staff salaries, ended up eating a larger percentage of their slightly lower sales from existing stores.
Right, like running a restaurant with fewer customers, your rent is still the same, but you're making less money to cover it.
Precisely. It was also impacted by the investment supporting the turnaround, including that additional labor and the Leadership Experience 2025 event we mentioned,
Right,
and of course, broader inflation hitting costs.
makes sense.
And specifically for the U.S. alone, comparable store sales declined 2%, driven by a 4% decline in transactions, though that was offset by a 2% increase in average ticket. U.S. net revenues increased just 1% to $6.454 billion.
Wow, so a lot to unpack there for North America. If I'm boiling it down for you, our listener, it sounds like more stores are open, which is good for revenue top line, but profitability per store is under significant pressure due to those investments and rising costs. It's a tough balancing act, isn't it?
It really is.
But here's where the global picture gets more nuanced, right? Let's turn our attention overseas to the international segment. This tells a somewhat different tale.
Yes, it does.
Here, comparable store sales were flat, a 1% increase in transactions, offset by a 1% decline in average ticket. But despite that flatness, net revenues increased a strong 9% to $2.0 billion.
Right. The international segment's revenue growth was driven by several factors. You had strong 7% net new company-operated store growth over the past 12 months,
Okay.
an approximate 3% favorable impact from foreign currency translation,
Always helps.
increased licensed store business revenue, and even some incremental net revenue from acquiring a UK licensed business partner. So, lots going on there driving revenue.
But what about profit internationally?
Well, the international operating income actually decreased 5% to $272.7 million, and the operating margin contracted 200 basis points to 13.6%.
Okay, so still some margin pressure there too. Why?
This was primarily due to increased promotional activity, things like special offers, discounts to drive traffic into those stores.
Got it.
But here's where it gets really fascinating, especially that contrast with North America you mentioned, specifically within China.
Yeah.
Despite the overall international flatline in comps, comparable store sales actually increased 2%.
Okay.
And this was driven by a strong 6% jump in comparable transactions, even though the average ticket declined 4%. So more people coming in, spending slightly less each time.
Interesting. And China revenues.
China's net revenues were up 8% to $790 million. It's a stark contrast to North America, and it really highlights these two very different engines of growth operating within the company right now.
That China performance is definitely a bright spot within international.
Yeah.
Shows the power of scale and market penetration, I guess.
Absolutely.
But what about another crucial part of Starbucks' business model, the one outside of its cafes? Let's peel back the layers on the channel development segment.
Right, the packaged goods.
Yeah, essentially their consumer packaged goods business. Think the packaged coffee you buy at the grocery store, the ready-to-drink beverages. This segment saw net revenues increase a healthy 10% to $483.8 million.
Yeah, and that revenue increase was primarily thanks to growth in their Global Coffee Alliance, which are these partnerships that help distribute Starbucks products way beyond their own cafes. Wider reach.
Makes sense. But again, profitability.
Well, despite the revenue growth, operating income for this segment decreased 7%, and the operating margin contracted quite a bit by 860 basis points to 45.1%.
Wow, another big margin hit. Why there?
This was mainly driven by a decline in their North American Coffee Partnership joint venture income, a mixed shift in products, meaning they sold a different, maybe less profitable blend of products this quarter, and higher global product costs hitting them there too.
Okay. Stepping back for a moment to the global footprint. The company opened 308 net new stores in Q3. Pretty impressive,
Still expanding.
bringing their total to 41,097 stores worldwide. 53% of those are company-operated, 47% are licensed. What's the geographical breakdown of that impressive number? Where are these stores?
Well, at the end of Q3, the US and China comprised 61% of the company's entire global portfolio.
61% just in two countries.
Yeah. 17,230 stores in the US and 7,828 stores in China. And this isn't just a fun fact, right? It underscores how critically sensitive Starbucks' overall health is to the economic and consumer trends specifically within those two giants.
Yeah, absolutely.
Any headwinds in these markets, like what North America is clearly seeing now, they ripple globally across the whole company's results.
Shifting to the broader financial health picture now, particularly those operating margins we keep touching on, we saw the consolidated GAAP operating margin contracted 680 basis points year over year to 9.9%.
Down below 10%.
And the effective tax rate increased pretty sharply to 31.8% from 24.8% in the prior year. For you, the listener, just to reiterate, what does a 680 or 770 basis point margin contraction actually mean? It means Starbucks is making significantly less profit from each dollar of sales than they were a year ago. That's a huge operational challenge. And what about that tax rate jump?
Yeah, these contractions, both in operating margin and the effective tax rate, they really reflect those significant investments being made, particularly the ones tied to the Back to Starbucks initiative,
Right.
as well as those external cost pressures like inflation. It really raises an important question. How do these short-term financial impacts align with Starbucks' stated long-term strategic goals?
Are they necessary pain points for future gains?
Exactly, that's the question. As for the tax rate, a large part of that increase, about 8.5 percentage points, was actually due to a technical accounting change. It relates to how they're treating profits earned overseas that they now intend to bring back to the U.S. Essentially, they're recognizing the taxes they'll eventually pay on those foreign earnings now.
Got it. Speaking of strategic goals, let's look at some of the recent company updates and strategic initiatives announced during the quarter. The company completed a $1.75 billion bond issuance back in May.
Raising capital.
Right, intended for general corporate purposes,
Hmm.
including repaying upcoming debt. And then in June, Mike Grams was appointed Chief Operating Officer, part of organizational changes aimed at accelerating their push to get back to Starbucks.
Yeah, and one of the most significant strategic moves, I think, in June was that Leadership Experience 2025 event we mentioned earlier.
The one impacting EPS.
Exactly. It gathered over 14,000 coffeehouse leaders from across North America. This wasn't just a big conference, it was a massive strategic investment. Starbucks gathered these leaders to re-energize them, equip them with new tools, and align them behind that Back to Starbucks vision of exceptional service and simplified store routines. This event was highlighted as a key milestone for the strategy, focusing on delivering exceptional service, simplified routines, and deeper customer connections.
Sounds ambitious.
And during this event, Starbucks also announced the expansion of the assistant store manager role across U.S. company-operated stores. They have an ambitious goal of hiring 90% of retail leaders from within.
90% from within.
It's a strong focus on internal talent development, really putting their money where their people are, you could say.
That's a clear investment in their workforce, and maybe a smart long-term play. Also in June, Marissa Mayer and Dr. Dambisa Moyo were elected to the board of directors.
Interesting additions.
Yeah, increasing the board from 9 to 11 members, bringing in some new perspectives, perhaps. And for shareholders, the company declared a cash dividend of 61 cents per share, payable on August 29, 2025.
Keeping the dividend flowing.
Right. This marks 61 consecutive quarters of dividend payouts with an 18% compound annual growth rate, or CAGR. That demonstrates a strong commitment to shareholder value even amidst these investments. So, what does this all mean for the big picture?
Well, it means the company is making some bold moves and certainly publicly expressing confidence despite the current numbers. CEO Brian Nichols stated, and I'll quote him here, "We've fixed a lot and done the hard work on the hard things to build a strong operating foundation, and based on my experience of turnarounds, we are ahead of schedule."
Ahead of schedule, huh? Bold claim.
It is. He also expressed anticipation for 2026, expecting a wave of innovation that fuels growth, elevates customer service, and ensures everyone experiences the very best of Starbucks, emphasizing they are building back a better Starbucks experience and a better business.
Okay.
So it's a narrative of short-term investment for long-term transformation. That's the story they're telling.
While leadership expresses confidence in the turnaround, What are some of the external factors or, risk factors the company itself identifies that could throw a wrench in their plans? Things that could impact future performance.
Mm.
What should you, the listener, be aware of?
Right, they have to acknowledge these. The
Yeah.
company points to several key categories of risks. Let's maybe dig into a couple. First, the brand itself.
Always crucial for Starbucks.
Hugely. In today's highly charged social environment, what if negative publicity campaigns or consumer boycotts gain more traction? We've seen how quickly that can impact a global brand like Starbucks,
Definitely.
directly hitting those crucial comparable store sales we just discussed. Second, they cite changes in consumer preferences, demand, or spending behavior.
Like people tightening their belts.
Exactly. Shifts in demographic trends, a reduction in discretionary spending, maybe reactions to price increases.
Right.
If people tighten their belts or simply prefer other coffee options, that hits their bottom line hard.
Makes sense.
There are also inherent risks of operating globally, things like geopolitical instability, shifting trade policies, local labor policies and conditions, including labor strikes and work stoppages, which we've certainly seen in the headlines impacting various industries recently.
Yeah, those are real risks.
And finally, they highlight the risk of higher costs, lower quality, or even just unavailability of key ingredients like coffee, dairy, cocoa, energy, or water. These are all external pressures they are actively monitoring, and they can significantly impact profitability.
So lots of moving parts externally, too. This deep dive has truly revealed Starbucks in, well, a pivotal phase, investing heavily in its back to Starbucks strategy.
Mm.
The financial results show the immediate impact of these investments, alongside that varied performance across global segments, North America, facing more headwinds than international, particularly China. It's a fascinating snapshot of a global giant trying to reset its course.
It really is. And it leaves us with a key question, I think. Given these short-term financial contractions from the significant strategic investments and the, let's face it, volatile global economic landscape, how do you think Starbucks will balance delivering on its promise of a better Starbucks experience and a better business, while also demonstrating that durable, sustainable, long-term growth that its shareholders are definitely looking for in the coming quarters?